good afternoon and welcome everyone. As Elaine said, this is the last QB of the year. Very welcome to those in the room and also to those online. So as usual, what I'll do is I'll kick in with a comment, talk a little bit about the numbers, and then maybe underneath a couple of issues we see that's really shaping those numbers and pieces of analysis we have in this QB. And then I very much welcome questions or clarifications or anything like that. Okay, so to jump straight in then at the headline on the next slide. So as we approach the end of the year, we've slower growth after strong post-pandemic recovery. We've moved on to a slower growth path essentially in the economy. When we look out over the forecast horizon, this is the first time we'll have 2026 within our forecast horizon. I would describe growth as being in line with medium-term potential. So that puts us in the region of 2 to 2.5%. And there's three factors which are shaping that path we see. So first is the recovery in real incomes, which we've seen for the first time have turned positive in the last quarter since 2021, and we see those feeding consumption as we go out the curve. And that second factor is after unusual weakness in exports in 2023, we expect exports to recover in 2024. Now, export growth is set to remain below or weaker than we would see as historical averages, and the main reason for that is the continued transmission of monetary policy. And it's not just necessarily ECB monetary policy we're talking about here, it's global rates, which are driving global demands. We're a small open economy, so if we see a reduction in external demand across the globe, obviously given our export base, we would see that matter quite a lot. And obviously then there's the second element of transmission, which is the direct transmission of ECB monetary policy. So that impacts the saving patterns and borrowing patterns of households, for example, and also the investment decisions of firms. Turning to inflation, it's fallen quite sharply in 2023, in particular in H2. The headline rate itself halved in the last 2 months. So what I would describe it as, we are forecasting the same endpoint, but the path to inflation is flatter than expected. More has happened quicker than we thought would be the case a quarter ago. But we do see this gradual reduction in the more persistent and domestically generated services inflation. But we do overall expect inflation to reach 2% by 2025. And the last point in the comment is around domestic policy, and essentially it will be very consistent with what we've been saying over the last number of bulletins here. It really is about ensuring the connection between monetary policy and domestic policy to ensure stability in the short run, to ensure we don't have overly created domestic inflation, which, if left unchecked, would impact the competitiveness of the Irish economy, and also at the same time contrasting against the need to build further resilience and medium-term capacity to deal with challenges coming down the pipeline. We've seen within the budget 2 funds be created, the Future Ireland Fund and the Climate and Nature Fund. That's highly positive, but I do think we need to just acknowledge that it's not the panacea for everything. We will still need to do a considerable amount of tax raising as we look at the ageing profile, for example, or even when we think about the infrastructural needs of the economy. Okay, so to dig a little bit deeper then at the numbers. So these are the numbers themselves, and maybe on this slide I'll take the opportunity to kind of give you a sense of what drove our changes in these numbers and also then where we see the risks to those numbers. So starting with growth and modified domestic demand, which is our preferred measure of the domestic economy. As I said, we see it relatively unchanged further out the horizon, growing at or close to potential of that 2 to 2.5%. But there is a recent or near-term adjustment quite sharp downwards, and that is stemming from mainly a one-off, I would describe it, or a normalisation of M&E activity, and in particular how it affected investment in the case of MDD. I'll talk a little bit more detail on that one in the next slide. The second, if we look at consumption, what's happening there, I would describe it as resilient but marginally weaker, likely reflecting inflation and also increasing interest rates. We do expect quarter-on-quarter growth though, so it's been a little bit weaker in the last quarter or two than we would have expected, but we are expecting a stronger Q4 as fiscal supports start to come into play across the country. And also, as we look a little bit further out, we also see some positivity around the real income growth, which has been restored, and we expect that to grow at around 2% over the projection horizon. Thinking about broader measures then of economic activity such as GDP, we get into this in a little bit more detail as well, but it has the same normalisation point in terms of investment that we had in MDD, but it also reflects that decreasing demand export or global demand. What we would have, and one way of thinking about this a little bit, when I try to characterise this is, if we take ourselves back 12 months and we look at what we would have expected, what large international organisations were forecasting to have happened. So take, for example, the IMF WEO, and you look at their GDP forecast and you look at their trade forecast. On the GDP side, what we've seen is actually huge resilience and actually a little bit ahead of what they would have forecast at this point. So when you look, they would have forecast 2.7% growth globally, we had trade. If you look at trade, although they expect a contraction down to 2.5%, it's landing at about 0.9%. So trade is well below what we would have expected, and that feeds directly into Ireland's GDP calculations. In terms of what you might classify as real goods and trades on the ground, which we might have in the likes of G&I Star, it has impacted those when you think of the pharma sector, ICT, but also, and we'll talk a little bit more about this when we get to that slide, in terms of contract manufacturing. So manufacturing undertaken by M&Es outside the state but come through our export channel. So in terms of inflation then, I would say the biggest revision here is a downward adjustment for 2024, and it reflects three elements. First is that recent data pointing to a downward shift in the underlying trend, and we'll have a little bit look at the underlying trend in a moment. Second is more favourable changes in commodity prices, although there's definitely upside risks to these. What actually has happened, and if you look at markets, what tends to happen here is if we don't price in an immediate shock that we expect a spike in terms of commodity prices because there'll be some supply shortage relative to demand, something like the situations we're seeing in Ukraine and the Middle East would cause actually a fall in global demand longer term. So it'd actually have the reverse effect. If they don't believe there's going to be an acute shock, actually it can have a downward pressure on commodity prices because of belief that world growth will just simply be lower into the coming years. And then the third factor driving the inflation outlook is the revised economic outlook downwards. But overall, as I said, 5.2% this year, minor change reflecting that extra downward momentum in the last quarter, and then trending towards our target by 2025. Risks then, we characterise the risks are tilted to the downside for growth very much, and we have 4 risks we outlined there. Most of them would have been carried over from the last bulletin, but definitely we see high tension in terms of geopolitics, and they could very easily cause, if there was to be a supply stoppage of oil, for example, and we would see a large increase in the commodity prices there, it would definitely inflect inflation directly and indirectly growth. When we think about, we do have that assumption in our forecast that we expect that normalisation or at least growth in exports next year from a very high level in 2022. We've seen the dip this year and come back up. If that wasn't to happen, or there was particular areas around pharma, ICT exports, for example, they would weigh on both growth and inflation next year. The effect of monetary policy, whether the transmission is stronger or it's a little bit weaker than we expected, definitely could go in either direction in terms of the forecast. Right now, we're aligned with the forecasting exercise the ECB did a week ago. And then obviously the domestic capacity constraints. I would say with the dynamics we've seen over the last quarter, maybe the headline level, some of those constraints are not as binding as they were in the summer, but certainly within sectors, it's still definitely the case. Okay, so then to move on to maybe a little bit more depth across a couple of the points. On the next one, we look at that point around investment and MDD. So as I said at the outset, we've moved to what I would call a slower growth path in line with potential. But this near-term piece, where we're seeing like quite a large revision in terms of MDD, I would say was a decision and a judgment we had to make based on very strong investment growth in 2022. And when you decompose investment growth, which is what you see here on the left, 2 sectors are the mainly what we might call the modern sectors in the economy. Pharma, ICT had very strong pandemic-related demand. We'll talk about the output they created on the next chart when we think about feed through to GDP, but it also had a big impact on investment. So some of the things you might think about here are like data centres, for example, semiconductor sites being largely expanded, pharma itself expanding and investing quite a lot. And the chart on the left shows here, the green line, these are the main 2 contributors to investment in the state. The green line here is property, building, construction. As you can see the previous boom we had and the fall off and the recovery. That is basically flatlined in recent quarters. But there's a very interesting dynamic under that one where actually if you look at housing delivery, that is still trending upwards, even in a higher rate environment. But other building within the state, which would capture infrastructure building, but also the CRE sector, is pointing downwards. So underneath that green line, there's 2 divergent series. But the pink line here picks up investment in machinery and equipment, for example, intangibles such as software, and you can see the very sharp increase we had during the pandemic and into 2022. It really spiked and drove a lot of the MDD. I think close to maybe half of the MDD figure last year was driven by disinvestment. So while it still remains elevated, it is normalizing down to a level. Truthfully, there's a piece here which we can model and we understand to be the underlying demand for machinery in the economy. Maybe work from home was in some of this expenditure, but there's some real key decisions that will be made by a couple of M&Es that drive the extent of that figure. So the judgment piece around that, and what we've seen is that come back quite a lot this year. So when we're trying to assess what's happening in the economy more generally, we try not to be skewed too much by what could be a normalization here to levels we've seen in the years before the pandemic. And that's what we try to do in the chart here on the right. We try to look through this piece that we just simply won't be able to model, to be truthful. And we have the outturn here, so the CSO's measure of MDD, which we're not saying in any way is not correct, but it does have this feature of the M&E investment in it. And we also do what could be seen as a nowcasting exercise, where we calculate modified domestic demand using our business cycle indicator and using our employment growth. So when you look at both of those there, yes, they're trending downwards in line with our assessment of a slowing economy, but they're still growing and growing positively. So that's us trying to look through the investment impact of this normalisation after a very strong level of investment last year by the multinational sector. And on the next slide, you can kind of look at the same issue but through a different lens and say, well, the investment didn't just happen. The investment happened on the fact that there was a huge increase in production. In particular, when you think about the level of vaccines created in Ireland during the pandemic, for example, was extremely high. And what we see here is the CSO break the industrial production into two series or two groups of sectors. One which you might call the modern sector, so that would cover medical devices, pharmaceuticals, drugs exports, vaccines, all of that would be included there, and also ICT. And then they have a traditional sector which basically captures the remaining sectors in the economy. And as you can see here, they were on two very diverging paths. They grew pretty much along seasonal patterns and that up through from the 5 years preceding the pandemic, but you can see a very sharp increase in the output of the modern sector. It grew 230% over 2 years, from mid-2020 to 2021, and it's retrenched back by about a third since then. So you can see this very sharp increase, but to us in reading that, you can read that as a normalisation. I don't think we could have ever expected a case where the demand for pharmaceuticals remained as high for vaccines when we were in a post-pandemic period, for example. So what we're seeing is a more normalisation of that, and that is feeding straight into our exports. On the green line, the more traditional sectors of the economy, there is some signs of slowing, but they are growing in the region of 5% per year, and that's been pretty constant. So there really is this divergent piece which is driving these near-term forecasts. So then when we think about what does that mean for exports, and on the right here, we look at, so the exports from the pharmaceutical sector, which will capture the likes of the vaccine exports, which were one of the world leaders in creation, was here in Ireland. We see a positive contribution in 2022, very much pushing up the growth in exports, but a real deterioration in terms of growth and also into negative territory by mid-2023. If we look at the teal line, we also see that it grew quite strongly but has fallen off considerably in recent quarters. So I think we will point to maybe potentially the box in the last QB, looking at some of what's underlying this. Some of it looks potentially to be geopolitical in nature. Some of our semiconductors, a big export line is to China, for example, and we've seen a large reduction, that's over halved within the last year. Then finally is the grey bar here, and when we talk about GDP and measurement within GDP, the grey line here, it's called here offshore goods, essentially is the technical term for contract manufacturing. So these are goods that are not manufactured in the state at all, but are manufactured by multinationals within the state, and they may have IP here, for example, they may have software here, which is being applied to that. We have seen a large reduction in that contract manufacturing. That likely reflects lower global demand, higher rate environment, for example, will be driving that. When you bring that picture together, this is what is forming our view in GDP, where we see it contracting this year by 1.3%, but a lot of that is driven by this net exports figure, which is heavily reliant on the contract manufacturing. Okay, so next one is inflation. So I think there's quite a positive story here in terms of inflation. We've seen quite a sharp decline in inflation in 2023. As I said, the headline inflation halved in the last 2 months. But there's a real challenge with inflation, in particular when there's quite a lot of change happening price levels, and that's to distinguish what I would say trend from noise. So ultimately, it'd be great if we could have a measure of inflation, what's happening month on month, to see what's happening right now to price levels. The problem is when you go to that level, you create an awful lot of noise. It bounces around quite a bit. So what they tend to do in the profession is do this annualized inflation. We think about an annual. The problem with annual is it can be quite hard to determine the pace of what's happening now relative to what happened 6 months ago, but there's a whole year of price changes within that. So some other measures have become more popular. You'll see the ECB refer to things like their momentum measures, where they're looking at movements within 3 months. But one other measure that we have estimated here is called instantaneous inflation, where they don't actually remove any of the year, but they weight the more recent observations higher. So it is a trade-off between the balance. And what you're seeing here is headline inflation is the blue line, and the pink-purple line here is that instantaneous inflation measure. And the point that is making is it's not just necessarily noise that we've seen over the last few months. We are definitely seeing, if you look at a number of underlying trend indicators within the bulletin, all point to a pickup in the downward trend and momentum of inflation. So that's a very positive story that we're seeing this fall off in inflation, maybe even slightly quicker than we would have thought, certainly compared to the summertime. But let's look at the composition of what's driving that, and that's what's on the right here. So the main contributor to that, which we would have seen a lot of, we would have expected, is energy prices. There's two reasons. One is a maybe slightly technical way of thinking about things, but this idea of a base effect, where simply because the price change didn't happen in the last 12 months, it just falls out of the year-on-year comparisons. But we've also seen some downward pressure on energy prices. In particular, last month, where quite a lot of energy providers had reductions in bills applied per unit used and such and so forth. So that's really pushed it down. But if we look at non-energy goods, for example, we also see they have gone into negative territory more recently. So normalizing supply chains, when you look at measures, and there's a number of created, whether it's cross shipping, whether it's cross supply chain indicators, they're all looking quite positive and a restoration towards pre-pandemic levels. So we really are starting to see that it's feeding through there. And we believe this downward momentum will continue, but at a slower pace. For example, we see there's lower commodity prices now, and we see those feeding through to final food prices, which do remain high at just over 6%, 6.2% at the moment. But we do expect those to continue into that trend. But I think when we step back and we say, what does this mean? So we still expect to return to target by 2025. And as I said earlier, the path to that is flatter than we would have previously thought. So more has happened a little bit earlier. But I also do think we need to be cautious and not to declare victory too early here, essentially. So there is services inflation, which is here in the teal bar. That is inflation which is more domestically generated. It has been more persistent. There are signs it's falling slightly, but it is very much, we see that being kind of the harder yards in terms of inflation to normalise. And this is where we talk about essentially wage negotiations, domestic pressures, capacity constraints. They are featured first and foremost in services. A lot of the remainder of the inflation basket is actually imported. We don't control energy prices in Ireland domestically, for example. A lot of the goods in that non-energy goods sector are imported in. So it really is, this is the Cupid, and this is the bit we'll be watching closely to see, as we tend towards 2%, the pace at which we go, that last 1 or 2% towards it in a consistent manner. Okay, so then to turn to the labour markets. So overall I describe the labour market as expected to remain tight out to 25, with unemployment remaining below 5%. If we take a step back, I would characterise the labour market as being in a state of excess demand since 2021. But there's a sign that's rebalancing, and I tried to capture that in a chart here on the left in terms of both the demand and the supply side of the economy. So if you take a proxy for the demand for labour here being job postings, and I have discussed this previously at conferences like the QB releases, where we did in project with Indeed, where we looked at the level of job postings on the website as a proxy, but it's a good forward-looking proxy for demand. That rose quite sharply post-pandemic, went up to 50% higher above where it was, but it has come back quite a bit and it's been on a downward trend. You don't want to be looking into things too early, but it looks like there's some stabilisation more recently at around 20% above pre-pandemic rates. Another indicator you can look at here is utilisation. So utilisation here is a measure the CSO create from the labour force survey, and what they do is it's not just necessarily the employment rate. They try to capture potential additional capacity out there. So for example, part-time people that would say they'd like to work more, people maybe marginally attached to the labour market, which although they're not seeking a job right now would be available to work in the coming months, and you can start to build a measure of what supply is actually out there. That rose quite sharply during the pandemic, which is not surprising with large closure, and it went below the level of pre-pandemic through 2022. But as you see, we've seen this return upwards close to the pre-pandemic levels in terms of this potential or underutilization, potential labour supply that's out there. And when you look at the individual data and what's underneath some of that, you can see actually people that are working part-time, there's an increase in the amount of them saying they'd be willing to work more hours, for example. So they're keen to get more hours working, those that are in part-time employment. And then on the left, or the right-hand side here, I put out a chart which has been a feature for a while, but it has an important consequence for the economy, and it's this idea of developments within employment in terms of number of people working and the hours working. So both are growing compared to pre-pandemic. Both are above their pre-pandemic rate, but employment is significantly faster growth. So we saw a lot of jobs being added over the last couple of years. Over 300,000 jobs were added over the last number of years, but average hours worked actually in the last quarter actually fell by 1.8% per worker. And this is not sector driven, and it's broad across sectors when you look at it. There seems to be this now, whether it is a structural feature post-pandemic, for example, that people are just working less hours or there's more part-time work. We did see a big increase in terms of the labour force. Maybe some of it's by choice. It's not driven by absenteeism. That was another thing that was put forward as a potential explainer of this. Is there more sick days in the system? There's simply not. They've returned to a normal level. But there is an importance here for the growth inflation dynamic. Because if we think about what drives inflation here, it is the wage cost, not necessarily the number of hours worked. So what seems to be happening here is the unit cost of labour, or what people are being paid per hour, is rising quicker than their overall income. And that has some interesting dynamics, because obviously overall what they earn matters most for in terms of what they consume and the feed through in terms of growth to the economy. But what their cost of an individual is per hour or per unit they work is what drives inflation. Because that plus markup is what drives, that productivity and markup is what drives the cost base for firms, and obviously the price changes. So that's one we are watching closely. I have one slide on wages then. So average hourly earnings turned positive in real terms in Q3, or at least they will when it comes back, for the first time since 2021. But there is large sector variation across what's happened here. And I tried to do two things, but I feel there's quite a lot of moving here, and almost there's stories within sectors when you think about large growth in terms of ICT early in the pandemic. You had pharma that was growing quite quickly in terms of demand. Then you had a reopening and a catch-up story, and they're all happening at slightly different levels. So what I've mapped out here are two things. One, what's happened since essentially right before the pandemic in terms of wage developments in real terms. So not just what's happened to wages, but wages accounting for inflation, and then what's happened in the last year. So as you can see here, there's a number of firms which are sectors which are above are running ahead of inflation. A lot of them are just close to a break-even level, and then there's some which are still lagging behind what's happened over a 3-year piece, even if they're growing maybe a little bit quicker. So ICT there is a prime example. Actually, in real terms, their salaries have fallen in the last 12 months. But if you account for it since the start of the pandemic and the start of higher inflation, they're up about 6%. So there is quite a dynamic there. We do public and private. So in terms of both of public and private are up over the year, public sector a little bit more. But if you account for the entire period from 2019, actually the private sector is up while the public sector is slightly below in terms of where their real earnings were at the start, and then the total has both slightly above. So then I want to bring your attention to a box that is within the QB this time on wages and wage developments at the real level and household incomes. Because I think there's an important story to tell here, and it really will matter as to how the economy evolves. So we would have had pieces, and we actually seen the most recent one released today from the CSO, but there would have been pieces of analysis which talked about how inflation affects different households differently. So in essence, what do we do with inflation? We take an average basket that the average person consumes and we work out how the price has changed. In reality, nobody or very few people is actually the average person. We all have personal choices within it, decisions we've made in the past, all the rest. And there's a lot of ways in which your consumption basket might differ. Like, for example, if you are an urban dweller versus a rural dweller, if you're older versus younger, if you're married with children, you'll have a different consumer basket than if you're single, for example. So there's lots of reasons you would have variation in what you consume, and you would be different from the average. But one that got quite a lot of attention was by your income decile. And what we saw early in the pandemic is actually lower income households experience a higher rate of inflation relative to high income. The reason for that is their consumer basket had more energy in it than the higher income households. So we thought this was quite a nice piece, but maybe it was half the story. So what we did is we asked the question, could we also do something similar on the income side? Could we also look at how the incomes have developed across lower, middle and higher income households and match the two of these together to simply give a sense of what's happened, the purchasing power of these households by their income groups over time. And what we've done here is differential income growth. Of course, when you look at the higher income individuals, for example, a lot of their income is salary driven, some of it's passive income. When you look at the lower end of the income distribution, a lot of it is social transfers and the tax system redistributing it backwards. So what we did was we took survey data and we combined this inflation impact with these income developments, and that gets us to our change in purchasing power. The left-hand side of that chart shows the situation and the evolution on average annually from 2002 to 2001. And when we look at that, it's been strongly progressive. What we see there is that lower incomes purchasing power grew on average by 2.6% per year, while higher incomes grew by 1.4%. And when you look at what causes that, and it's a reflection of our tax system, social transfers and taxes actually cause 2.1% of the 2.6% growth for lower incomes. So there's quite a lot of redistribution goes on within Ireland. So we've this quite progressive system where actually over time lower income households can afford more of their basket relative to higher income. But then came the pandemic, large inflation shock, and quite a lot of supports were in the system. So we tried to look at that in isolation. So the right-hand side of that chart shows us between in 2022 and 2023 over the 2 years, and this is a more regressive story. So what we're seeing here is lower income individuals have seen their real income fall by about just under 4%, 3.7%, and slightly positive in terms of the higher income households. What really is happening is here, income has done more work at the higher end of the distribution to offset the inflation they face, and they've had lower inflation to this point. Where the lower income individuals have had higher inflation, and while there has been a lot of social transfers within the budgets, it hasn't done enough to fully put them at a position where they would have had growth or broke even relative to the start of the pandemic. And my real takeaway from this piece of work, it underlines the importance of when we talk about targeted measures, for example, we talk about taking those views. Really, this is the demonstration. What you're trying to do here, as much as possible, is have that redistribution in line with what you think is the fairest outcome through a large shock like we've seen, or a number of shocks through the last 2 years. So then, my final slide is on monetary policy. A lot of the room is well aware, given you cover this on an ongoing basis, but rates increased by 450 basis points, policy rates, since July of last year, and the ECB have held them constant since September. The forward guidance at the ECB talks to maintaining these at a sufficiently long duration, and they make a significant contribution towards our medium-term target, returning to our medium-term target of 2% inflation in the medium run, which they've become quite focused on 2025 for that. And they've talked about how they see rates evolving going forward, and a real focus on a data-driven approach as opposed to a time-driven approach. So there's no forward guidance that says we expect rates to go up, down over a set number of months. They said they've been data-driven, and they've 3 criteria in which they are looking at that based on. One is an assessment as data comes in. A little bit back to our point around what's happening underlying inflation dynamics, what's happening, the outlook in terms of their projections, and then finally looking at the strength of monetary policy transmission. When we bring that to Ireland, or this is even true at the euro level, monetary policy works through a number of channels, and its impact will only be seen with a considerable lag. Peak impact, when you look at the literature now, we would expect to see it through 2024. But early signs are there around transfer to banking rates for lending, or even deposit rates. And one piece we had talked about previously was this change in deposit rates. In Ireland, it lags Europe in terms of pass-through to deposit rates. But what we have seen is that from a low base, term deposit rates are beginning to grow quite quickly. This is the chart here on the left. But I will stress from a very low base, but they are reflecting the change in interest rates as it's being passed through. So I will stop there. I think the infographic from our More comms team is the next slide, and I'm very happy to open it up and take questions. Thank you very much.
Thank you very much, Bob, and I'm delighted to introduce our other colleague earlier on, Martin Ryan, who's our head of Irish economics and analysis division. So I know everybody knows everyone here, but I should have done so, so my apologies. So look, we go around the houses, folks, in no particular order. Can I ask people just to keep to 2 questions each in the first round, please, and we'll go around again if we have a minute. So without further ado.
Just in terms of modified domestic demand, is it a little bit problematic now in terms of getting a good read on what's happening within the economy, given that component you talk about, it's usually the M&Es? And second question would be, just on my last point, is there any sense of any leakage of household savings outside the jurisdiction, perhaps seeking higher rates in other Eurozone banks?
Okay. On the first question on MDD, I would say, so I don't know whether it's necessarily a good read of it's affecting our read of the domestic economy, because these are machines which are being used in Ireland, for example. The problem is the size of it relative to the investment that happens on an average year. So there's some very big investment happening, for example, like we needn't cloak it out in Leixlip, for example. There's a huge increase in a fab base for Intel, for example. That's so large relative to other investment that happens within the state, it actually features through to national accounts. So pieces like that can give you some short-term volatility, more than I would say that MDD is not a good read for the economy. So I just think we need to look through a little bit of that volatility for trying to see actually what's happening on the ground for local firms and consumers, but I wouldn't necessarily see a need to deviate away from us thinking about MDD unless anything you'd like to add. On the second point, I might ask if Martin knows more, but to my knowledge, I don't necessarily see, I know the growth in deposits hasn't been as large, but I don't think there's been significant movement of deposits from the Irish retail institutions to elsewhere in Europe, but that's to my knowledge, but I don't know.
Was online, Corey, anything from you?
Yes, hi, thanks everyone for the presentation. Just a question on compensation per employee. I think it's revised sharply down from about 5.9%, I think, in the Q3 bulletin, to 3.5% now. Just wondering what's sort of behind that, what I suppose didn't happen that you thought might happen 3 months ago. And how are you kind of confident on the 5% for next year, when I suppose it didn't come through this year, and arguably if inflation is easing, employees, unions might have less bargaining power going into next year? Thanks.
Okay, I might ask Martin to come in after I say something initially around how we thought about the revision, but my sense is there's a real almost delinking of what's happening wage development and CPE itself, because the number of employees growing, for example, is having quite a large impact on CPE, so that's pushing it down a little bit. But I might ask Martin if you want to give a little bit more detail on how we came to revision.
Yeah, sure, and it is, I mean, it does sort of hinge on that sort of strength of employment growth that we have seen. Perhaps a little bit more surprising than what we would have thought. But the real challenge for us in then trying to interpret that for, say, inflation developments and wage developments more generally is that while we've seen employment growth about 4% in the first 3 quarters of the year, the average hours worked by employees has actually gone down by about 2%. So, when you're trying to put all of those bits together, you get a sort of a strange then feed through to compensation per employee, because there's more people working. On average, they're working fewer hours, but their hourly wage rate is actually increasing. So it's trying to map all those things together that's a bit challenging for us at the moment. When we look into the future and we think about the confidence around the sort of the relative the 5% that you refer to, I think the challenge that we have there is that we do see quite a stark fall off in that pace of increase in employment. So while we say overall it's been growing by about 4% for the year, it's now down to about 2% as we move into 2024, and our expectation is that it's going to weaken even further as we go in through as we come to the end of 2023 and as we go into 2024. So this sort of positive boost that we have had from a surprisingly high level of employment, we're not expecting it to be as significant as we move forward, and that sort of underpins the 5% average wage growth in essence in the forecast.
Thanks, Martin, and thank you, Mark. Go back and join here, Robert.
Thanks very much. Thanks for the presentation. I'm just wondering, the way that yourselves and others have explained the fall off in multinational exports in the pharma sector and in the contract manufacturing sector, and how one has come from a very high base and the other one doesn't have real employment effects. But then suddenly growth just picks up again next year. And I'm just wondering, how confident are you that growth can return? And if growth in those sectors doesn't return, does it really matter? Given that it's come off such a high base and given that contract manufacturing doesn't have any real employment benefits as such. And then just a second more, just a clarification question. In that box on the effect of real incomes, am I right in reading that for middle income earners that their real incomes are only back to 2019, 2020 levels? If you just maybe go into those numbers in a little bit more detail.
Maybe I'll start with the clarification and then come back. So with those charts, the chart we displayed there is the actual growth rate, average growth rate in each year. So I think per chance they approximately are at that. They're maybe even slightly below it because it's a slightly negative growth rate if we take the Q3 quantile for income. So it's slightly negative on average over the 2 years. So it wouldn't even be quite back to it based on that chart. On your M&E question, I think you made the right separation between, there's two components here, right? So there is the element which, and this is where it gets tricky when you think about GDP and we talk about measurement issues. So the contract manufacturing point you made is correct. There isn't much employment attached to it here in Ireland. It is predominantly done abroad. Now, it does impact potentially through other channels. For example, if you think about corporate tax receipts and you think about other things which would impact the state, but it doesn't necessarily have employment here. It doesn't have, and this is when we point to it's not a good measure of economic activity here in Ireland. MDD, on the other hand, which is our favourite one, treats the economy as being quite closed. It's like as if we don't trade with the outside world at all, which seems a little bit short-sighted in terms of a small open economy. So the piece in the middle where we see a large reduction in like pharmaceutical exports, and that's why I had the industrial production, they are goods created here in the state, not ones that are created on the demand, if you like, of multinationals externally. They're created here in the state. So they do have employment effects. They have, for example, consumption effects if they were to continue on a downward trend. Where we take our assumptions from here is not just necessarily we do have a slower growth pack, but when you look at the likes of what the IMF see happening in terms of world demand, we are trying to bring in some of that thinking in terms of we were surprised, not just us, the global economics was surprised with the retrenchment in trade this year. They see a restoration that we see a similar one, not up to historical levels of growth, but certainly a return to some growth. But if there was to be sector-specific reasons, for example, and this is maybe, if you like, a risk we would call out when we talk about corporation tax, but the same thing features here. These are very large multinationals working in quite similar areas. So if there was to be, for some reason, pharmaceuticals was to have a reduction in demand again into next year, that would really be a downside for the actual economy and feed through to MDD. Ultimately over time, and not directly because exports are not in there, through employment, income taxes for the state, all of those challenges. I don't know what you...
Yeah, I mean, the first issue there is in essence the corporation tax and the sort of the vulnerability or the volatility that is there with respect to these excess corporation tax receipts. When we look at the multinationals or their contribution to Ireland in total, it is really there that's their first port of call, and this is where the contract manufacturing exports could potentially be featuring in some of the sort of the less robust growth in corporation tax receipts in the current year than what we have seen in previous years. In terms of the wider issue around the export growth more generally, a lot of the sectors that we're talking about, the frontier seems to shift relatively quickly. If you think about the semiconductors or some of those sort of technology sectors, within 2 or 3 years, they're onto a new cycle of a new product that they want to actually be at the frontier of. And so we may be in a situation where some companies, they're winning in the current cycle, but their real bet is on, well, what's the next frontier for, whether it be aspects of AI technology or whatever the case, whatever the next sort of frontier in terms of chip technology or something might be. And that's really going to be the key issue for us into the forward-looking aspect is how much do the relevant sectors and the relevant operators that are both in Ireland and who manage activities on behalf of their companies abroad, how much do they keep at that edge of the frontier in these sort of high-tech these high-tech sectors. And just on your first question there about, yes, you're right, they haven't noticed, the middle income earners haven't got back to, in essence, 2020, but they're sort of just there around 2019 to 2020.
Thank you very much, George. We'll go back online. Owen, how are you doing?
Hi, how's it going? Thanks so much for the presentation, guys. I just wanted to quickly ask, you've probably mentioned this, but contract manufacturing, how much does it account for in terms of total exports, goods and services? And then secondly, the kind of narrative and commentary has changed from the focus on inflation has kind of switched to whether the ECB has done too much. Is the chief risk factor to your forecast now just how monetary policy plays out? Might the impact be bigger than you account for or than you're predicting?
So I might ask Martin to come into contract manufacturing. You might have the numbers to hand around contract manufacturing itself. So I think when we think about what the biggest downside risk is, I think it's global demand more generally, and I think there are some acute risks in terms of particular sector-specific risks for M&Es, for example, which drive a lot of our exports that are actually created here. Martin covered that quite well in the last question. When we think about the path to monetary policy, actually, and the ECB were quite clear on this, I wouldn't necessarily say we are now on a path which is a bigger risk. I think it is, we have done 450 basis points of increases in policy rates. What we have seen is those feed through to lending conditions in the euro area, we've seen them feed through to lending rates. That looks at this point to be quite strong, but there's big questions we have to answer, like, for example, is there a little bit of front loading there? And truthfully, I think probably the bigger piece for us to understand and will drive some of those monetary policy decisions as we go into next year across the euro area, but they're also acute for Ireland as well, is the mix between how wages evolve, creating those domestic pressures, productivity that could potentially offset that wage demands in terms of inflation, and also the capacity for firms to absorb any of the wage catch-up because of the markup, which was increased last year. We are seeing signs that some of that is happening, but the mix between the three of those is really what will create the path forward in terms of inflation and hence the path for monetary policy. But on contract manufacturing?
So the contract manufacturing over the first 3 quarters of this year accounts for about 17% of total exports. It was about 20% of total exports last year over the first 3 quarters. So there has been a decline. It's gone down by about 13 billion basically. It was 100 billion. It's now running at about 85, 87 billion.
Okay, so it accounts for 20% of exports last year, you'd say, goods exports?
Yeah, for the first 3 quarters and about 17% for the first 3 quarters this year. Of total exports,
okay.
Yeah.
Total exports, okay. Thanks very much for that.
Thanks, Owen. And back here, Jennifer.
Just a quick question. Apologies if I think this is probably been covered a little before, but just, in terms of 2023 and, sort of uncertainty and risks, like, how do you think that we'll see changes very soon in 2023, or do you expect it to be further out?
In terms of risks, is it, sorry?
Yeah, like both, in terms of MDD, like if GDP continues to drop, do you think that we'll see a shift in that?
So I think, and to the discussion we had earlier, I would nearly describe MDD as a lagged indicator when you think about these external developments, because ultimately we don't have exports directly in there. So it will be when it comes to employment challenge, for example. But if we were to see, for example, one of the bigger downside risks I see is that we don't see a recovery in global trade. We don't see this growth in global trade that's being predicted next year. If that was to happen, then Ireland, and it depends on the composition of that, but if that was to happen, both in the traditional and the modern sectors, for example, we're very focused on talking about the modern sector, mainly because it's had a big increase. So that's normalising. But if there was to be a case that global demand didn't recover next year, or there was to be higher levels of domestic, so there's 2 sources really of where the growth is going to come from. One is that external demand one, which sees a restoration of growth in exports, and the second one is real incomes will recover and drive consumption locally. So if we were to see inflation to be higher than we expect and it weighs on that, or we were to see the external environment for whatever reason, that could be geopolitics, it could be rates that are higher for longer because of inflation becomes more persistent than people expect at this point, it could be for a number of reasons. They are the 2 big factors I would see shaping it. MDD will lag the likes of a GDP, which will have those exports in their GNI star. Yeah. Thank you.
Thank you very much. Everyone have a line. So just to
Can you hear me?
You can, right on.
Yeah, afternoon all. Thanks for the presentation. As inflation is coming down quite sharply, I think faster than many people expected, do you expect interest rates to stop rising and actually come down fairly soon? I know it's not in your remit, but what's your opinion on it?
Okay, so I think right now, if we look at the situation, it is coming down. Momentum is a little bit higher, but back to the point we've discussed around potential persistence in domestically generated inflation. Where I see the interest rate pattern, I think the ECB were quite clear about this. There's a lot of data to come. They have been open about being data dependent. And one thing that struck me last week when they spoke was the ECB have a wage tracker where they have this survey that they follow loads of people on their wage development. 50% of that wage tracker will have their wages renegotiated in the first half of next year. So by the time we see how wages, and people do expect a level of catch-up, but the mix between that level of catch-up, the productivity that might change going into next year, and there's a lot of features weighing on productivity, whether you look at it per employee, per hour, for example, and also the capacity for firms to absorb these will be the determining factor in terms of, or will be key determining factor in terms of at what point we think, inflation will have returned or the future path for the interest rate. So for me, that is a key consideration when I listen to President of the ECB talk. That's really where I see, that's the data points I would really be looking at over the next few months to kind of ascertain where we are in terms of the economy and wage developments featuring into inflation.
Okay, thank you.
Thanks, Richard. Back here, Ronan.
Just following on Christian's question, actually, you say in the release that the ongoing transition of tighter monetary policy will weigh on growth and then just already in the class constraints and we're on a slower path to grow, on a slower growth path. If the ECB did decide to reduce interest rates, is there any assessment of what that might mean for growth?
I don't think we've done a scenario of quicker.
No, but I mean, what's embedded in the forecast in terms of the interest rate profile is, in essence, the market expectation of interest rates maybe 3 or 4 weeks ago. So at that point in time, you would have seen a sort of a baking in of maybe policy rate reductions toward the the middle toward the end of next year. And so that's already embedded in the numbers. If you did see any sort of movement away from that path, you would expect to see growth being a little bit stronger, inflation being a little bit higher. But broadly speaking, and that's where we call them out in terms of, well, will the impact of monetary policy be a little bit different than what we understand in the baseline case? But the main element in the forecast is based on an interest rate profile consistent with market expectations about 3 or 4 weeks ago.
Thanks, Ronan. Back on line, Ellie. Let's come through. I'll come back to you in a few minutes, okay? Just in case anything's not working. Sarah.
Hi, yeah, I have 2 questions. One is back to the wages question. So you said middle income earners have not yet caught up. You also said that lower income earners haven't. Do you have an idea when that may happen? And what are the bands? What are you talking about as a middle income and lower income earner, maybe? And a second question on your recommendation to government that policy actions should not aggravate demand and targeted measures could have been more targeted, I think what you're saying. Like, what do you make of the budget row that's been going on between the sort of the government, fiscal council, ESRI made some comments, and especially because last week the IMF said something about central bank macroprudential rules possibly aggravating house prices. Do you agree with that? And how does it impact overall inflation, which is what we're talking about today? Yeah, thanks.
Perfect. Maybe starting with the questions on this chart. I don't know if you have, but we can certainly follow up.
We'll follow up with those, yeah.
But essentially, it's the income distribution broke up. I suspect they'll be very close together over a number of the centre quartiles where a lot of the income distribution is, and then the tails will be slightly further. But we can certainly.
And maybe just to clarify, when we're talking about income here, we actually mean, like, in essence, all the income that the household is taking in. It's not just what they get from, say, working. It's also what they were receiving from, welfare transfers, etc., etc. So, but that's just. We'll come back to that.
And on your second question, so firstly on the IMF report, I think this is the Article 4 report. I think what they talk about in terms of stoking potential housing demand here are the changing macroprudential rules that happened last year. I think in particular they're pointing at the change to loan to value for second and subsequent buyers. So my reading of that, and it's my colleagues that would engage directly on that, my reading of that is looking at one element in isolation. I think when they undertook that review, it was much broader than that. And when you look at the trade-offs between what happened in terms of limits for these individuals, like we've now pooled limits, it is hard, or I haven't seen quantification that actually, when you look at it in totality, we've loosened it. I think there was trade-offs within it to try and reflect changes that happened in society, to try and reflect access to financing, for example, for first-time buyers. So I personally wouldn't come to the judgment that it is increasing housing demand. I think necessarily the biggest issue facing housing demand is there's simply more people rather than it's a credit conditions piece. I think there's just a cumulative effect of more and more households trying to afford a house, and simply the supply, while growing, is struggling to keep up with that demand, especially cumulative in nature. On the fiscal piece, are you talking about the commentary around the rules, or?
Yeah, so overall, has the government overspent, I think is the big question, because it broke its own spending rule.
So I think if you step back and you look, the budget was expansionary in nature. The budget, and our own governor said he would have had a slightly less expansionary budget. So I think when you look at it, where guidance on the way in would have been to stay in line with the 5% rule. I think there's been a lot of commentary around the 5% rule itself. I'm happy to add my little bit into that. So my sense is when you take a step back on this rule, the way in which we think about fiscal sustainability is usually through two things internationally. One, is it some type of debt to GDP ratio? And the other one is deficits. Both of those don't work very well for Ireland, right? GDP is in one, which we can't measure very well, and excess corporation taxes is in the other. So if you're actually going, you could be very unprudent and living have a very, very expansionary fiscal position and live within those rules in the Irish setup right now. So I think there's wide regard that they can't be done. The government, with the SES a number of years ago, maybe in 2020, created this rule where it simply broke down potential output. They estimate to be about 3%, seems quite reasonable to me, and inflation of 2%. I think crucially, in the absence of these other more internationally established rules working, building credibility in that rule is very important. I think there's some debates we can have around, when you have an inflationary shock like they've seen, whether you should allow it to act countercyclically, which would be my own view, or whether you should be, you can deviate from that rule short term. These things are to be debated. But crucially, I think we need to establish credibility in that rule, and we need to think about it in terms of what it means for Ireland, given these other measurement issues in terms of GDP, given the excess corporation taxes. So my own view is less on, debating over and back some of the more nuanced elements of it, but we need to establish credibility in the rule that they created for this purpose.
Thank you very much. And last but not least, Ellie.
And just a quick one then on consumer sentiment. Where do you expect that to go in 2024?
Consumer sentiment has been sort of bobbling along relatively positive, not got back to sort of pre-pandemic levels just yet. But broadly speaking, what we have embedded in the forecasts is continued growth in consumer spending, of about 3.5% to almost 4% next year. And we have also seen obviously an increase in excess pandemic savings that households are beginning to draw down and have buffers for certain households, that is. So between the easing of inflation, between that sort of buffer of savings that households are and the relatively tight labour market, the growth in wages that we're expected to see over the forecast horizon, we still see a relatively positive outlook for consumer spending going forward.
Okay, listen, thanks very much everybody. Boring reminder that the embargo is after midnight. Thanks again to both Rob and Martin, and for everybody who has followed it and is here. And Merry Christmas to anybody that we're not talking to between now and then.
Thank you very much.
Thank you.